Thank you very much for having me. It is a pleasure to be here, and it's been very, very interesting so far. I just want to give you a quick, so you understand. You can all hear me in the back, I'm assuming, right? Just so you understand, I spent 40 years on the New York Stock Exchange as one of those guys that ran around screaming, yelling, serving the institutional community. I then left there after the world change and technology took the place over, although I was there from 1980 right up till 2019, so I lived through all of those events that we all know. I am now the Chief Market Strategist at a wealth management company down here in Jupiter, Florida. So my perspective is very much from an institutional side. It's very much U.S. and I really talk about what's happening in the U.S. markets and kind of where I see the eco data going and the things that should concern or not concern us. I write, as Mike said, I do write a daily market commentary blog. Some of you may get it, may not. It appears on my Twitter and my LinkedIn and all that. But it's really the perspective that I write daily about what I think is happening in the markets from the role that I had kind of standing in the thick of it at the New York Stock Exchange, and I kind of lay out where I think what I think you should listen to and what I think you should just ignore, right? The perspective as a day trader or as a broker on the floor is very different from the perspective as a long-term investor, right? The long-term investor is much more worried about the long term. The day trader wants the chaos, they want the noise, they want to hear it all because it's the chaos in the short term that creates the opportunity for the day traders. It gets in the way of long-term investors, and it kind of causes long-term investors to, if they can't eliminate the noise, it creates a lot of anxiety, which is exactly what we saw over the last 6 or 8 weeks, ever since Liberation Day, when for a while there we all got liberated from our money, but it's coming back. It is coming back. Today, maybe not so much. Market's off a little bit today, but I think that's just because we had kind of a very swift. While it wasn't a complete V, there was some time there where it was kind of churning, which is actually the good thing. That's what you want to see what happens after you had such a swift decline in the market. Look, the decline at the swiftness, the speed at which the decline happened is a little bit unnerving. But understand that the speed happens because of the technology that exists today and some of the leverage products that exist today that just when it hits the fan, and the speed at which the market declines is amplified. And that creates a lot of nervousness for certainly the long-term investors. But I keep saying to clients that I have and other people that just want to talk about the markets is, as the long term, you got to kind of focus and make sure that the thesis, the reasons that you buy and own the stocks you own, hasn't really changed, right? If you're a long-term investor, you're buying these stocks for the long term. You're not buying them for today, tomorrow, the next 10 minutes, or the next 2 weeks. And so your perspective you have to take a step back and have a different perspective and just make sure, while it is uncomfortable, certainly over the last 6 weeks and for a couple of days it was very uncomfortable, if the thesis hasn't changed for your individual names, then there's no reason to panic. And in fact, what you'll see is a lot of those names have come right back. And a lot of those names are actually higher today than they were on Liberation Day, right? And so you've seen the recovery in clearly the big name stocks. A lot of them driven by tech, and you heard Dan Ives this morning talk about his view, and I agree with him, right, in terms of AI and changing the world and all that stuff. And tech needs to be a part of your portfolio. But there will certainly be periods of angst, which I think get amplified. In that sense, as the chief market strategist, I'll talk broadly about where I think we are, right? I don't think Jay Powell's cutting rates this year at all. As much as Donald Trump wants to stamp his feet, I just don't think Jay Powell's going to do it. I don't think he's going to do it because I still think, as we heard, or as people are talking about, is that there's this sense that inflation is going to start to lift its ugly head again. I don't think it's going to be out of control the way it was during Biden. I don't think we're going back to 9% CPI. But I think it's going to stay here and tick a little bit higher. And that's going to keep Jay Powell in a position to say, I'm doing nothing. And I actually think that that's the right thing to do. By the way, 4.25% rates I don't find usurious at all. And for most of the people in this room, I would imagine you would agree with me, because we all lived. I was 19 in 1980 when rates were 21%, right? I was just getting out of college. I bought my first house with a 15.5% mortgage. Many of you probably did the same thing as I look around this room, right? We're all the same generation, so you get it. But what I find has happened is that There's a whole generation of people that came into this business, whether they're traders or wealth managers or investors, that came in here in 2007, 2008, when the world fell apart and rates went to zero around the world and negative in some parts of the world, and stayed there for 15 years. And these people are all going, oh my God, 4%, how can I do this? Are you kidding me? And so 4.25% to me is right in line, because the historical, really 4 to 6% historically is very normal. But you try to explain that to a 30-year-old that knows that, oh my God, rates were zero for 15 years. Yeah, right, and they should never have been that low for that long. I understand why they went there, but I'm in the camp that they stayed there way too long. And now we're going to pay the price. Because for 15 years that they kept it at zero, it's not going to be over in 2. It might take us just as long to get out of it. Which is why 4.25% for me feels okay. And guess what? The hard economic data is not falling off the ledge saying, oh my God. It's not. If it were, then I'd say, okay, we had a problem. But at the moment, it is not falling off the ledge. And they talk about, well, the soft data is getting nervous. Well, guess what? The soft data is opinion data. It's not hard measurable data like the CPI or right, where you can actually measure it. The soft data is, someone calling you up and taking your opinion on what you think. And so here's the problem with that. Who are they calling? Are they calling everyone on the left that's got TDS syndrome and so they hate everything about it? They're going, oh my God! Because they're clearly not calling people on the right, because people on the right don't necessarily have that same opinion. And so when they say the soft data is going off the edge, okay. But the hard data doesn't necessarily confirm that, at least for me, not right now. Now, I'll change my mind if the hard data starts to go off the ledge. I don't see it going off the ledge right now. So I don't think Jay Powell's cutting rates, and I don't think he should. So that's number one. That might really drive Trump crazy, but the fact is, it is what it is. Jay Powell has a job to do, and Trump has a job to do. I get it. But I don't think he should be in a position, and we went through that whole thing where he's threatening and doing all that stuff. Okay, it's great. That's just his style. I don't agree with it, but it is. But I don't think Jay Powell's going to cut rates. And so I think people need to get used to these rates at 4.25. Now, I don't think rates are going up. I think they're going to stay right here. And I think staying right here is actually okay. I think, mortgage rates at 6.7 or 6.8% are fairly normal. They're not normal compared to 2.5% that they were getting, but it's not the 20% in 1980 or 1981 that they were. Now, that wasn't right, and this wasn't right. Where we are right now feels okay to me. And I would imagine anyone, I'm looking around the room, right? I'm 64, so I'm the end of the baby boomers. So I see a lot of you out in the room. I'm assuming we're on that same page that, this is not the end of the world, and that rates where they are not necessarily usurious, right? I also think that as a long-term, my role as a long-term investor, we design these portfolios. So, you got your core portfolio, you got your high dividend growth, you got your enhanced dividend growth, you got your small cap, mid cap, all that stuff. I think if you're doing it on your own, you should be in the market. You should be properly weighted. You shouldn't be overweight any one thing unless you're so sure, or you want to make a bet, whatever industry it is, whether it's tech, whether it's consumer staples, healthcare, whatever it is. But you got to be balanced, and you got to be in the biggest names in the sectors you want to be in, because those are the ones where you're going to get the most value. Yes, some of them are not sexy. Some of them are boring. But boring is good, especially in an unstable environment, right? If things get nervous, you don't mind being boring. Look, because we were very sexy for the last 2 years. It was great. Now the market's, kind of figuring out where it is, and there's a lot of nervousness, whether it's around trade and tariffs and all that stuff. And what's going to happen. I think it's okay, right? I'm in the camp that, is his negotiating style with tariffs a good thing? I'm actually of the opinion that trade agreements that were written decades ago need to be revisited. Like so many things need to be. Look, I worked on the New York Stock Exchange. We did it by pen and paper, face to face. We screamed and yelled at 1/8 of a point. All that's gone. Because we revisited it when technology changed and the world changed and 9/11 happened and the threat that that made to the markets. And so it's just different. And so it's been renegotiated. The market functions fine. Now, would I like to go back to the screaming and yelling? Absolutely, because it was the greatest place in the whole world. But it's not going there. And so when they talk about trade agreements or they talk about, the threats of tariffs and all that stuff, great, but it's clearly bringing everybody to the table. Everybody's come to the table. The UK's come to the table. The European Union's going to come to the table. China's come to the table. Now, say what you want. Is it just a memorandum of understanding? Have they ironed out the rules yet? No, not yet. Scott Bessent made it very clear. There's more conversations to have. But I do think that it's okay. I think it's okay to shake it up a little bit. But I also then think as a long-term investor, you have to understand that it's going to shake it up a little bit, and you have to position yourself correctly, right? You have to be well-balanced. You have to be kind of in the biggest names. Although, it's so funny because I always thought UNH was such a great company. It's getting slammed. But I think you have to still be in the biggest names that are out there in the sectors you want to be in. I think you also have to, in our position at this point in our lives, I think you also have to have a portfolio that's going to spin off a decent dividend income. Not necessarily that you're drawing on it, but that you're just reinvesting it, right? And you're building it up to help continue to build your portfolio. Again, I talk to people. A client of mine that I have that's managing a bunch of money for their grandchildren, but that's 50 years away. And the guy's nervous about what happened in April. I said, what are you worried about? This is for your they're not going to look at this money for 50 years. This is like a little blip. Right now, it doesn't feel like that. But in the bigger picture, this will be a little blip. Now, again, if you're somebody that's 80 years old and you need this money to live on, you shouldn't be that much in the market. Right? So if you are, well, then we should sit down and have a conversation. But you shouldn't be. And so you have to kind of look at your perspective in terms of who's the money for? Is it for you? Is it for your wife? Is it for your kids? Is it for your grandchildren? And then you're going to be able to make a better decision in terms of how it's allocated. If it's 40 years out, you should be further out in the risk scale. If it's something you need in 5 years, you clearly shouldn't be that far out in the risk scale. And you shouldn't be overweighted, certainly equities. And if you are, you should be in the boring stuff. Right? Big and boring is beautiful. Energy names, look, someone was asking a question about nuclear energy. I think nuclear energy is coming back big. You look at a lot of these, Dominion, you look at CEG, there's a couple of other names out there that you might want to look at, SMR, are all in the space really big. Dominion, by the way, pays you 4% divvy. And it's a big name in the space, and they're big into nuclear energy. So if you think nuclear energy is going to be a theme, you should be looking at a name like Dominion. Right? If you think AI is going to be a theme, clearly AI is a theme, right? But names like Nvidia and Palantir, Amazon, Apple, all those names, they're not going away. Apple makes $100 billion every 3 months. Think about that for 1 minute. $100 billion. Every 3 months, they make $100 billion. Where are they going? So it's funny. Apple trades, and here's the other thing, especially when there's nervousness and the market sells off. The big asset managers, when the market sells off and they reallocate and people want their money and all that stuff, where do they go to sell stock? They go where they can make a sale very quickly in a big name stock and raise a lot of money. So where do they go? They go to Apple, they go to Amazon, they go to Google, they go to Meta. Not because the thesis for those names has changed, because they can raise a lot of money very quickly. And you should be thinking about the same way, right? When you need it, where can you go to raise money, and where should you go when you're investing it in terms of your time frame and where you are in the risk scale, and then where those stocks are on the risk scale, right? Consumer staples now, boring, but they'll offer stability. Utilities, boring, they'll offer stability. But if rates go up, utilities are going to go down. Even though they're good dividend payers, if you can get 5% in the Treasury versus 3.5% in a utility stock, you're going to go to Treasury. I get it. But if rates come down, then utilities are going to be a great place to be because it's going to give you exposure and it's going to give you good dividend income, right? But you have to kind of understand where you are and where you want to be. I don't think rates are coming down. I don't think they're going up. Like I said, I think they're going to stay right where they are, and I think he's right. While I will agree with you that he completely screwed it up on the way up, completely, I don't think he's screwing it up right now. I think he's right to hold them where they are. And so I think that's what you should consider. I know I got the sign already for 5 minutes. I'll keep talking unless somebody's got a question or two before I have to leave. Nobody's got a question?
Oh, wow. Come on. Well, I'm gonna walk a microphone to anybody who has a question. So
that either means I did a good job or I didn't. I'm not sure what it means.
Well, we got one in the. Where are we at? Oh, there it is. Thank you. Pardon me. Get through eventually.
I know what you're going to ask. I know what you're going to ask.
I want to make a comment here with regard to the governments.
Yeah.
We have Donald Trump in office, and this is for the first time that we have a businessman running government. I mean, the closest we came was Ross Perot. I mean, and that.
Well, this is the second time because he already did it 4 years.
Yeah, the second time. And it's interesting to know that what I'm seeing, and I don't know, you could give me some judgment as well, that we're going to see the world, not just the United States, but the whole world is piggybacking on this. And so we'll see it all over the world where governments are governing as capitalists, not from a negative perspective, but as business people, where you're running a company. And I think that is great for the world, which tends to make me believe that we're going to see some sides of inflation. And what you just mentioned about making sure that, Jerome Powell, I think you're spot on. Jerome Powell is being very cautious about this. And despite what Donald says, we have to be very careful with that because it could blow it out of proportion if they want to take that that approach.
Yeah, no, I agree.
So those are my thoughts. But I think the globalization, we have momentum. There's globalization under the same lines. So those are my thoughts.
Great.
Up in the front, yeah.
Who, somebody else or no?
I might have a question.
Oh, all right.
I don't know if I guess this is working, yeah, if I speak into it. I saw the market rolling over in January, and I went into a lot of cash. And a lot of the cash I took, I put in short-term treasuries. And you see the long-term, the 10-year going up now. But the short-term treasuries pays almost as much. Why the government, when it was zero interest rates, why the hell didn't they sell 30-year bonds?
Listen.
You know what I mean?
100%. They should have sold 50-year bonds. We don't have them, but they should have created them and
Right.
sold them. But they should have. Janet Yellen, in my mind, made a complete mistake when she didn't sell long-term money at 1% rates, because she could have done that easily.
So everything rolls over and rolls over and rolls over.
And now we have the problem because she was using short-term to fund the market, and now with all that's got to come due at much higher rates, which is the problem, right? And so as they bring more bonds to the market to pay for all this stuff, that's going to put more pressure. More pressure is going to send bond prices lower and yields higher, right? That's the exact problem. So to answer your question, why didn't she do it, Janet Yellen do it when she had the chance? I don't know. She should have. Clearly she should have. People told her to, but she did it her way. And look where we are now. Anyway, I think I got to go.
Well, one last question would just be, and I'll just ask for the audience. You mentioned, I guess, the boring and then also some of the more exciting stuff. You mentioned Apple. I guess that's kind of in the more exciting category a little bit. What would be a couple names in boring or exciting that you like in addition to that?
So in the utility space, it's nuclear energy, but I still think it's because it's a utility, I think it's more boring than exciting, would be Dominion and CEG, are both two names that I like. In the consumer staple place, look, consumer staples are typically, there's nothing sexy about consumer staples, but in an environment where you're nervous, you can play it a number of ways. You play it either with the ETF like an XLP, or you buy, individual names. So you might buy Kellogg or Procter & Gamble or, one of the, or Kimberly-Clark. one of those names. But certainly in the sexy space, I gotta lean towards tech. I gotta lean towards AI. I gotta lean towards semis, right? Because that's clearly, the theme is clearly AI. I fully support that. You can see how it's changing the world. And so I think you have to have names like Palantir, Nvidia. I certainly think Apple. I'm not a big Meta fan. I was never a big Meta fan, so I never owned Meta. I never did a Facebook account, although people laugh at me because I do have WhatsApp and Instagram, so I guess it's the same thing. But I never bought Meta, and I never bought Google. But Amazon and Apple, IBM, I love IBM. And then in the banks, look, I love JPMorgan. I own it. I own Bank of America. The firm does too, just so I put it out there. But that's where I would be. Look, it also reflects who I am at 64 years old, right? So all those names I just mentioned are all big blue chip names, right? You know them. JPMorgan, Bank of America, IBM. Doesn't get any more blue chip than that. Apple doesn't get any more blue chip than that. So, but that reflects where I am on the risk scale and where I am in the life cycle, right? I don't have 40 years. I may not have 5, but you know what I mean? Anyway, there you go.